Welcome back to Global Macro Pulse. Today, we are witnessing what I can only describe as a historic, almost violent divergence between sovereign emergency actions and pure price reality.
Yeah, I mean, the tape is flashing red right now. It's an unbelievable volume divergence.
It really is. I mean, we are taking a deep dive today into a market that has completely decoupled from policy gravity. We have traditional central bank policies just violently colliding with kinetic geopolitics and, well, structural trade wars.
Right. And if you're managing money right now, you have to completely ignore the political noise. You have to look strictly at the numbers because the sheer scale of what we're seeing in the commodities and bond markets is unprecedented.
Unprecedented is the right word. Let's start with the energy shock because I'm still trying to wrap my head around this. Out of Paris, right, on CET, the International Energy Agency just unleashed a 400 million barrel emergency oil reserve release,
The largest in history.
the largest in human history. And they dumped this into the market to crush prices. And yet, WTI crude it shrugged it off. It violently bid up, closing at $88.44.
Yeah, it chopped around in a massive $82 to $88 range before settling there. And Brent crude hit $91.54.
Which is just a massive macro headwind. I mean, Washington on ET, the White House has signaled that they are intervening in the oil futures market concurrently.
Right, they're trying to manage the paper market while Paris dumps the physical market.
Exactly. But paper contracts can't fix a systemic risk in the Middle East. I mean, Iran is openly threatening to completely block the Strait of Hormuz. They're talking about implementing chain strikes.
And we're already seeing the physical kinetic action. The IRGC is fired on 3 disobedient commercial ships in the Gulf.
Yeah, and the U.S. military has warned civilians away from Hormuz port facilities. We had a drone hit the USS Lincoln.
It's escalating fast.
It is. And closer to home, out of Washington, ET, there's an FBI warning about potential Iranian drone strikes on California launched from the U.S. coast.
Which is terrifying, obviously, and the rhetoric is matching it.
Right. You've got Trump saying Iran has nothing left to hit, claiming the war will end soon. He's openly wanting to personally manage the Iranian succession, especially since Supreme Leader Mojtaba was injured in that late February strike.
Yeah, and then on the other side, the Iranian president just laid out 3 hardline conditions for peace. Right.
Yeah, recognized rights, war reparations, and international guarantees. But, looking at all this feels like the ultimate systemic risk to global supply chains.
Okay.
A leadership vacuum in Iran, plus direct attacks on shipping. No amount of paper futures intervention can fix that.
I hear that, but I have to bluntly challenge that historical fear-based view.
Okay, challenge it. Why?
Because if you actually look at the tape, the market doesn't buy it. First of all, OPEC just maintained its completely flat demand forecast.
But the physical attacks?
The attacks are headlines. I'm looking at mechanics. The sheer mechanics of a 400 million barrel physical dump create a massive volatility skew. You can't just ignore that volume.
Fair enough.
And if you look at the charts, they show $88 as a key resistance level.
Meaning what for our listeners?
Meaning every time WTI hits 88, algorithmic sellers step in and hammer it back down. The market fundamentally does not believe the Strait of Hormuz will fully close, regardless of what the politicians are yelling.
Wow. So they're just completely discounting the kinetic risk.
They're pricing it precisely at $88. If they actually believed 20% of global oil was going offline, WTI wouldn't be at 88, it would be at 150.
That is a brutally rational way to look at it. But if the physical energy market is ignoring the geopolitical chaos, the bond market is certainly not. Let's pivot to the macro headwinds.
Yeah, let's talk about domestic economic policy and inflation, because the numbers are fascinating today.
Out of Washington, ET, at 8:30 a.m., U.S. February CPI dropped, and it landed exactly on expectations.
Headline at 2.4%, core CPI at 2.5%.
Which on the surface looks like a perfectly benign environment.
Right, and because it met expectations perfectly, the algorithmic trading response in equities was completely muted. No panic, no rally, just noise.
But the bond market is screaming something entirely different.
Exactly. Look at the yields. The 10-year Treasury yield is sitting right at 4.231%. The 2-year yield is at 3.661%.
So the spread between those two is telling us that the bond market is pricing in severe long-term structural issues.
Yeah, the bond vigilantes are looking right past that 2.4% CPI print.
As well they should. I mean, analyzing that 2.4% CPI print today is like analyzing weather data from last week while a Category 5 tariff hurricane is forming just offshore.
You're talking about the Section 301 trade investigation.
Absolutely. The incoming Trump administration is preparing to launch this Section 301 investigation to pave the way for sweeping new tariffs.
Right.
This is the dawn of pure fiscal dominance. When you restructure global trade with massive tariffs, you completely upend the benign inflation baseline we just saw.
It's inflationary by definition.
Exactly. That 2.4% CPI print is historically irrelevant right now.
Well, and the global players know it. Over in Asia, anchored in Beijing CST,
Right.
China's government work report just set their 2026 GDP growth target at 4.5 to 5%.
Right.
And they deliberately anchored their CPI target at 2%. They are mechanically preparing their domestic economy to absorb these structural trade shocks.
They are bracing for a massive liquidity cycle event. And speaking of liquidity, we have to look at precious metals and sovereign action, because this is where the real paradigm shift is happening today.
Yeah, the metals tape was brutal. Spot gold suffered a really sharp intraday drop today, all the way down to $5,149.01.
It clawed back a bit to close at $5,175.91, but still.
And silver took a much heavier hit. It dropped nearly 3% down to $85.69.
Which brings us to the U.S. dollar index, the DXY.
Right, the DXY aggressively reclaimed the 99 level, closing at 99.26.
Which is acting like a wrecking ball. But there's a sovereign angle here that is it's historically profound. Out of Warsaw on CET, the Polish central bank is reportedly looking to sell its gold reserves.
Yes, specifically to fund national defense programs.
Which is just an incredible historical irony. I mean, for centuries, nations hoard gold during wartime. It's the ultimate safe haven asset.
With traditional playbook.
Right. But modern kinetic warfare is so incredibly expensive, the drones, the defense systems, that European nations are literally being forced to liquidate their physical gold just to buy immediate security. It's a massive shift in how sovereigns view liquidity.
Okay, I have to reject the philosophical angle on this one entirely.
Really? You don't think a central bank dumping gold matters?
I'm not saying it doesn't matter, but I look strictly at the DXY. A dollar index pushing past 99 automatically forces a mechanical sell-off in gold. That's just quantitative gravity.
Sure, the dollar strength is a factor.
It's the primary factor. Furthermore, you have to look at the structural shifts on the exchanges. The CME just lowered margin requirements for gold and silver futures.
Right, making it cheaper to trade.
Which is a classic trap. They lower the margin, which lures all these retail traders into highly leveraged long positions because they're watching the geopolitical news you just mentioned.
Ah, I see where you're going with this.
Yeah, they get over-leveraged. Then the strong dollar pushes the metal down, it falls below its 200-day moving average, and boom.
Margin calls.
Massive margin calls. It triggers painful mechanical liquidations. That intraday drop to 5,149 wasn't about Poland's defense budget. It was forced liquidations clearing out weak hands.
Wow. Okay, that is a razor-sharp read of the mechanics. But you can't deny that the balkanization of the global economy is real, especially when we transition away from heavy industry and look at the tech sector.
The tech decoupling. Yeah, the tape here is completely ignoring government red tape.
It is wild. I mean, out of Washington, ET, lawmakers are drafting legislation to expand AI chip export controls globally.
Right, forcing companies like NVIDIA and AMD to secure entirely new licenses.
It's a direct balkanization of the silicon supply chain. And simultaneously, China's central bank, the PBOC, announces this aggressive push for AI application in their financial sector.
And yet, despite all these regulatory crackdowns, tech equities remain highly idiosyncratic.
They don't care at all.
Nope. Oracle surged 9% today. Meanwhile, Chinese tech names like Bilibili and iKey fell about 4%.
Which leads me to ask you a very provocative question.
Go for it.
Are these global AI chip export bans the 21st century equivalent of an oil embargo? Think about it. By restricting the flow of compute power, which is the foundational resource of the modern economy, aren't we creating a new layer of systemic risk for tech valuations?
Philosophically, maybe. But I'll say it again, look at the tape. The market doesn't care about the export controls.
How can they ignore a global embargo?
Because the corporate demand for AI infrastructure is blowing right past those regulatory speed bumps. Oracle ripping 9% proves that.
But the infrastructure itself.
On the infrastructure side, look at the supercomputing internet. They are handing out 10 million free tokens to every OpenClaw user right now.
Basically giving away the currency for compute power to drive adoption.
Exactly. It's driving massive, ravenous compute demand. Add to that, Apple's foldable iPhone is slated for later this year, keeping the consumer upgrade cycle alive.
So the demand side is bulletproof.
As long as the earnings data holds, all these regulatory fears out of Washington are just basis points of noise in a much larger structural bull trend.
Basis points of noise. That's a bold statement, but the data backs you up today.
It does.
So let's synthesize this tape for our listeners. What are the portfolio implications here? We started by noting that geopolitical risk premiums in energy are basically being artificially suppressed by historic IEA reserve releases.
Right.
So investors really must look past the paper intervention and focus on the underlying structural supply deficits.
Exactly. And on the macro side, look at the yields. With the DXY holding firmly above 99 and the 10-year yield sitting elevated at 4.2%, capital is going to make a very specific choice.
Flowing away from the rate-sensitive stuff.
Yeah, capital will continue to flow away from rate-sensitive assets and precious metals. It's going to flow directly toward high-margin tech, like Oracle.
Despite the geopolitical chaos.
Despite all of it, the margins in tech are simply outrunning the inflation and the tariffs.
Which leaves you, the listener, with a final provocative thought to chew on today. If central banks are now selling physical gold just to buy drones,
Right.
and supercomputing tokens are being handed out like candy while AI chips face global embargoes, are we fundamentally mispricing what the true safe haven asset of the next decade will actually be?
Something to think about.
Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.